Well, Mike and Ryan, I want to thank you guys for taking the time to really have a conversation about probably one of the most interesting quarters we've ever had. I can say in my time, it's the most interesting quarter I've ever had. So I'm really interested to hear what you guys have to say, to sort of get an update on what's happened and what to put things into context. I feel that there's a lot of news, a lot of busyness, a lot of noise out there about what's been happening. So I really look forward to our conversations to sort of put it into a plain English simplified format, and then really just get a sense of, how you guys are navigating so that when we come out the other side, that everything's as good as it can be. So maybe I'll quickly pass it over to you guys and we'll go from there.
Great. Yeah, thanks a lot, Scott. Definitely, it has been very crazy times. The year started off quite strong in the first month and a half or so, and then later in February, things started to get a little bit more volatile around COVID-19, originally coronavirus, and things unfolded. So we'll definitely share a lot of information and spend more time on COVID-19 than anything else today, because imagine just based on our conversations with clients and advisors, that's probably the top thing on people's minds. But Ryan, let's start on page one. Just a quick overview. We often talk to clients about challenges facing investors, and obviously there's been some market volatility challenges recently. And one of the points I make on this page is no diversification sometimes when you need it. And there was about a 2 or 3 week pocket in March, which felt pretty tough because stocks were down significantly and bonds were down significantly. So what do you do in those kind of environments? Low interest rates, well, they were low December 31st, and they've gone a lot lower. The 10-year bond yield at one point intraday dropped down to 0.3%, closed a little bit below 0.5%. But what are you supposed to do when interest rates are 0.5% locked in for 10 years and rates have still stayed very low? And, I think the challenges facing investors, how do you continue to meet your income objectives and your long-term aspirations and retirement goals and social impact goals in this kind of environment? So we'll talk a little bit about, the environment we're coming out of and the environment we're in now. Highlights of 2019. We're going to do a bit of a good cop, bad cop routine today. Ryan's asked me to cover the past 2019, so I'm going to share a lot of good news, and then Ryan will kind of get you caught up in terms of quarter one and where we sit today and how we see things unfolding, and then we'll wrap things up with me just talking a little bit about where we see the world unfolding and how we're positioning clients moving forward. But 2019, there was easier global monetary policy. Interest rates dropped in the U.S. 3 times last year, despite the economy being quite strong. Growth started to decelerate a little bit, reaching a bottom. We saw a lot of positive progress on some key risks. U.S.-China trade war tensions was, it's kind of old news now, right? But, that's what we were concerned about last year. And bond yields, we thought, were kind of bottoming at that point. And, what transpired in that environment when interest rates go down and we're in a decent economy is that equities do pretty well. So you saw international equities up 16.5, Canadian equities up 22.9, U.S. equities up 24.8, all in Canadian terms. So that's some pretty phenomenal results. Bonds also had a great year, up 6.9. So last year there was really nothing to complain about, and our numbers on a relative basis were extremely strong in that positive environment. And this just gives you a sense. The dark green is our portfolios. The light green is the market. So there's always going to be some areas that outperform more than others, but we had some significant outperformance, in particular in global equities. And we were overweight global equities versus Canadian equities all of last year, also going into this year and when this whole thing's unfolded. So when Ryan covers his slides, you'll get a sense that that's been very favorable. Now moving on to 2020, I'll turn things over to Ryan, and he'll talk a little bit about how the world has dramatically changed since that very positive market environment in 2019.
Yeah, thanks, Mike, and thanks for leaving the negative numbers to me today. But
didn't you choose that? I think you did. I think you did choose to cover the negative, or was that me?
You're right.
That's called the short
straw.
I'm telling you.
I certainly did. So Scott, today we'll talk about what we've seen so far, and we'll talk about what we've seen rattle the markets, which has really been the greatest supply shock in modern history, combined with the greatest demand shock. And then you overlay that with oil price shock. And I think we can all agree that the anticipated end to the 11-year bull market has been upon us. And we've also seen historic levels of government stimulus. But when we look to the first 3 months of this year, coming off a strong 2019, as Mike just mentioned, we'll see some of the hardest hit areas of the world, Canada being at the top of that list with returns at minus 21%, followed by the international market at 15.2 to the negative, and then U.S. stocks at minus 11.7. Canadian bonds squeaking out a positive rate of return for the first 3 months at 1.6. And we think it's notable to point out as well the currency, and the currencies had an impact as international currencies as well as the U.S. dollar have appreciated against the current Canadian dollar. And that has been a positive for the portfolio, which we'll talk about, because we have made a choice to be exposed to that U.S. dollar. So when you look at the last few quarters, and what we're looking at here is an equity component of the market. So essentially 45% invested in Canadian stocks, 55% invested in international and U.S. stocks. You can see the trajectory, which was upward sloping through Q2 all the way through the end of the year to 2019. And then that good first 6-week period that Mike mentioned. And you'll see in the Q1 2020, that first green circle there, community transmission of the virus globally, we can mark that at the time of this recording, at least, as the top of the February 19th, as the top of that market after a good first 6 weeks, which then led to the volatility we've been experiencing. When you get to that bottom of that steep downward sloping curve, we can mark that as of right now, March 23rd, being the bottom we've experienced thus far. And really, the bottom coinciding with the stimulus package that we've seen come out of the U.S. government, which has been the strongest, but what we'll look at in a few moments as well as the stimulus provided by global governments on the fiscal side as well as monetary side has been quite good. But generally, an equity portfolio dropping, again, on balance, about 16.5% over the first 3 months of this year.
I mean, quite honestly, the perfect storm that was created by the oil production increase and the flood of oil that was put onto the market in conjunction with the COVID-19, everybody needs to go and stay home. So the demand now for anything has just simply plummeted. I mean, without those two combined, do you think it would have been a sort of a longer drawn out process, or did that just accelerate the decline and sort of just make everything just kind of just the bottom drop out?
Yeah, we'll talk about that too, Scott, but it's a good question. You know, when you have essentially production stopping and, producing that supply impact, and then you have that economy hitting that wall and demand for many things tapering off essentially to zero, whether it would be travel and leisure or other most basic essential or necessities that we'd be used to. I would say if you had one over the other, it probably would have been a longer drawn out period of weakness. When you combine them together, it has led to a steepening or at least a faster pace of the volatility. And then what we experienced when we saw the oil shock per se, between feuding between Saudi Arabia and Russia, and the supply of oil coming into the market when the demand has essentially gone away in the short term, it really compounds not only the depth, but how quick we've experienced this drawdown. You know, we talked about equities being volatile over the first 3 months of the year, but bonds experience some volatility as well. And what we're showing on the left side of this page is the Canadian 10-year yield. And it's essentially, as an investor, loaning money to the Bank of Canada for a 10-year period and what they're willing to pay us on an annual basis for that loan. And you can see going back to October of 2018, where we stood, the Bank of Canada willing to pay an investor $2.50 of interest for every $100 loan that they make to the Bank of Canada. We came into this year on January 1st, and that had decreased to about 1.7%. In the past call, we've talked about that decrease and what that meant for bond prices through 2019. But that continued to drop through the first quarter of this year, through the first 3 months. And January 1st, we started this yield at 1.7, and it essentially decreased by half. March 31st, representing 0.8%. Mike alluded to this a little bit. There's that intraday low you see in March as well at about 30 basis points. So we've seen yields reach historic lows, but at the same time, we've seen credit spreads, and credit spreads defined by this Bank of Canada rate, and then you put a spread based on a corporation. And as you are loaning money to a corporation, you're buying a corporate bond, but that company may not have, as an example, taxing authority, and therefore you demand a higher rate of return. And this spread dictates that higher rate of return, which is really defined by what you feel is the risk. And you can see it's been pretty steady since 2018, and then it just really blew up. And we see spreads that have increased from 1.4% to about 2.6% in this environment, which is about an 80% increase, which is quite significant.
And just on that point, if you think back to the last time we've experienced anything like this in 2008, credit spreads between higher quality corporates and governments blew out to over 4%, like a bank bond versus the government of Canada. That was a tough year to hold any kind of corporate bond. But in the following year, in 2009, just in a conservative bond portfolio tilted towards corporates, we were able to deliver, close to 14-15% returns in a conservative bond portfolio. High yield bonds for us delivered 37. So we're not expecting quite the same opportunity that we saw coming out of 2008, but we are seeing a bit of an opportunity presenting itself in corporate bond high yield that hopefully we'll be able to take advantage of at some point this year.
So you're suggesting that as that spread narrows, that's where the gain is going to be had.
Exactly. If you can just lean in when that is at its peak. Basically when things feel the worst, like March 9th of 2009 would have been a good time to buy corporate bonds and high yield bonds.
Yeah, that's very interesting.
And to that point, Scott, high yield bonds were something we decreased a little bit in a balanced portfolio through the summer of 2019, which has worked quite well. And as Mike mentioned, this increase in the spread makes those same bonds much cheaper than they were in the summer at that point. So you're right, there could very well be an opportunity that similar to what Mike mentioned that we experienced in 2009.
Well, it sure is good to have tools in your toolbox to deploy at the right time. So yeah, that's interesting to hear.
What we also experienced, was in a normal period of volatility, you expect a significant, what we would call flight to quality. There's capital that is leaving the equity market, and that capital has to be placed somewhere. And historically, gold has been a good placeholder in a period of volatility. And we really didn't see that this time around. And we did see gold increase in value by about 4%, but that was really on the back half of March, a few weeks ago. And that coincided with the last week of March also producing better positive rates of return in the equity market. So we really didn't see that same flight to quality to gold, or at least less volatility, as you can see here in the chart on the left-hand side. What we also experienced were correlations around the globe, and correlation really being the relationship between two stocks and how they move based on the same information. Positive correlation means two things move in tandem with each other. Negative correlation representing things that move opposite to each other based on the same type of information. And you can see as this green line spikes upward and downward, the high point, whether you look at the crash of 87 or the current COVID-19 crisis, means that correlation has been the highest, meaning all things are moving, which also signifies that there was no real good place to hide through the deepest period so far through the volatility that we have experienced in February and March. But what we have noticed is what's held up quite well. And what we've realized and experienced, companies with more debt have certainly underperformed. These are the companies that we have significant underweight in our portfolio, or we don't own these companies at all. Throughout 2019, as Mike mentioned, we took some profits on the equity side, and we were more cautious given what we were seeing in the global economy and a weakening global economy, not knowing, of course, that a virus was going to take hold. but really trying to articulate where our compensation was coming from for the same type of risk. And we didn't feel like companies that have a lot of debt on their balance sheet would adequately, adjust their returns for the risk that we were taking. So we've certainly seen those underperform. But on the other side, companies that high profitability, high profit margins, we've also seen outperform. So our teams have done a really good job in being underweight or not owning the companies with a lot of debt, having cleaner balance sheets, and therefore preserving capital much better in the current environment. And at the same time, owning the companies with strong cash positions, nice balance sheets, and a healthy profitability to make sure that we can weather this storm on behalf of our clients well, which is exactly what we've done. So if you think about how we've constructed the portfolio and some of the things that have worked and worked well, having, global equity and our team on the global equity side has done a great job, but also our asset allocation outperforming, the underlying benchmark, so the World Equity Index outside of Canada by, high single digits on the global equity side. And then the asset mix decision by having more capital invested outside of Canada than within Canada, including being exposed to global currencies, including the US dollar, has certainly helped the portfolio preserve capital through this period of volatility, and it's worked out quite well. Core bonds provided positive rates of return, slightly behind the benchmark, as we'll see when we look at performance, not because the bonds we held were not the right bonds to hold. In fact, the interest rate decisions that the team made were quite good, but some of the investment grade corporate bonds detracted somewhat and offset some of the rates of return for the first quarter in the core bond portfolio. And our Canadian equity value detracted slightly as well. We saw an experience in the first 3 months during these periods of volatility, people concerned less on the valuation and the relative value of a company and more concerned on the future earnings potential of a company. So we saw that detract slightly as well. So when we look to performance, again, a very different picture than what Mike talked about for 2019 as a whole. This represents the lighter green shaded bars, the underlying index, and the darker green bars are pools. You can see there our core bond portfolio just over 1%. You can see the TSX down about 21%. Outperformance there in our income and growth strategy, as well as our core growth strategy. Slight underperformance in the value strategy and small caps, of course, the hardest hit, whether you look in Canada or outside of Canada as well. You'll see the global portions of the portfolio in Canadian dollars. So the world index, excluding Canada, down about 13%, and our portfolio is coming in at 8.7% of the downside and 7.7% of the downside. So again, significantly outperforming the underlying benchmark as well. And our multi-strategy portfolio, which you'll see there at the bottom of the page, that zero is not a typo. It was flat on the quarter. And over the last few weeks, based on this recording, it's doing quite well. We're sourcing that portion from the portfolio from our bond allocation, because given what we've just seen, given the decrease in yield on the bond side, we do feel that bonds are a little expensive and won't provide future growth, although they do provide stability during periods of volatility. And the alternative investments, you'll see real estate, infrastructure, private debt. Those are the rates of return as of December 31st. So those are the last 3 months of 2019. Real estate came in at 5% for the quarter, infrastructure at 2.3%, and private debt at 2.7%. So they each had great years.
Hey guys, and just a further comment there, real estate on a 12-month basis ended December was up 13, infrastructure was up 11.1, and private loans was up 8.8. So even in a good equity market environment, those investments held up well. And I'll talk a little bit about what's new in those portfolios in quarter one. Multi-strategy, just in the month of Ryan mentioned that it was zero year to date to the end of March. But in April, the portfolio is up 5.8% so far. So it's really been delivering, and it's had a very attractive, positive, absolute rate of return for the year.
That's a good point, Mike. And that 5.8 also ahead of core bonds as well. So as of today, multi-strategy outperforming bonds. When we take it out a little broader and we look to the global environment, there's three key things, and this is probably one of my favorite slides here. We can see economic growth, and it's no surprise that it's significantly weaker. We'll see very ugly numbers being reported for Q1, potentially Q2, due to these supply and demand pressures that we've seen. A technical recession is probably what we're experiencing today, and but at the same time, historically large fiscal stimulus programs to help offset or absorb some of the economic weakness that we've seen so far. Inflation on the lower end, of course, negative growth will drive inflation lower, and there's certain products that certainly may experience higher levels of inflation. We may have seen the headlines regarding medical equipment, and low supply but high demand will lead to that inflationary experience. And then looking ahead, supply disruptions and larger deficits potentially may lead to higher rates of inflation in 2021 and maybe into 2022 as well. And then finally, monetary policy. We've seen central banks, whether the Bank of Canada or the Federal Reserve or central banks across the globe slash overnight rates, and it's been much easier in that way. And they've all instituted aggressive quantitative easing measures. In Canada, particularly, the Bank of Canada buying bonds and injecting cash into the market, which is also something that they did not do going back to the financial crisis of 08 and 09. And of course, this quantitative easing purchases include everything from government debt to corporate debt, and in some cases ETFs, which again, I don't believe we saw going back to that financial crisis of 08, 09.
I mean, I get what's happening with the monetary policy. I mean, they've got to inject cash into the markets, like literally helicopter money coming in order to keep the economy moving, to keep cash flowing through that. But if you go back one slide, is it not fair to say that maybe that monetary policy will get us across that first bridge that we need to get across, which is to get people back to work, to get the COVID contained, and then to get cash flowing and economies and things moving again. But is that that little dial you've got there that's way to the right, is that not eventually going to pull the inflation dial way to the right as well?
Yeah, it's a good point, Scott, and you're right. That's something that we're thinking about over a longer period of time. The injection of capital, you could, not that we're comparing this experience to the financial crisis, but what propelled some of the great strength following the financial crisis was the cash and liquidity available to the market. We didn't see inflation to that degree, but if we had a crystal ball, and to your point, we could see this in the future, and the ability for continued low rates, high amounts of cash within the marketplace, and demand coming back as well, there is potential for inflation to drive significantly higher given all those inputs. So you're right. And there'll be things that monetary policy central banks will do at the time to try and taper that, and that'll also be increasing rates. And that'll be something that we keep our eye on, because again, that'll be a concern when we're past this pandemic and into a more normal environment. The concern will shift back onto how central banks now begin to ease that cash out of the system, but make sure that we don't have a double take in terms of a weaker period on the economic front or another shorter term recessionary period.
Yeah. No, I mean, the definition of inflation is sort of the increase of the money supply. When they're buying that many bonds and just writing checks on the Bank of Canada, which basically can write checks until forever, because they're just adding zeros to a keyboard that just adds it to the system. But then trying to get that money back out of the system to curb inflation. I mean, my gosh, increasing interest rates from the low level they're at right now. I guess when the governments have utilized that lever to the extent that they have, and they've lowered it as far as they can, and they still can't drive the economy forward, it's like a last ditch effort is the monetary policy to get money into the supply. But then how do you slow that down? How do you slow inflation down? I mean, I get that in slowing inflation is when you raise interest rates, but if you've got no growth, you can't support the raising of interest. It's a real big challenge that I'm trying to I'm trying to deal with how in the long run. I get for the short run, we're going to get over the bridge, and that's what's necessary. But now it's, I guess the second phase is taking a look at, okay, what do you do to then protect against the inflationary pressures? So I guess there'll be for a future conversation, but it's on my mind for sure.
Yeah, and this is something, Scott, we'll be talking about for many quarters to come, because it's something that we've talked about as well, and we'll see how they manage it. I think the concern now is to float the U.S. economy as an example for as long as they need to ensure that they don't have employment that continues to increase, which we'll look at in a second as well. But it's something that we'll certainly come back to many times after we're past this pandemic for sure. But it's a good question, and it's certainly a good concern. If we were to shift now and we were to focus on COVID-19 and the spread of it, and put some visuals around what we've experienced so far, China versus the rest of the world and the daily new cases and how that may coincide. What you'll see, the lighter green representing the world, excluding China, with the darker green line, including China, you can see there's that peak or that reclassification, and their daily new cases have certainly come down. They're further ahead along than we are here in North America or other parts of the world in terms of being past this crisis. And many people might say, can we really trust the data that comes out of China? And to that point, we look at it as we have in the past with a bit of scrutiny. But there's many other things that we keep a close eye on when it comes to data coming out of China. Everything from electricity consumption to ridership on the subway to live web and camera feeds on ports across the country. These are all things that we track on a daily basis to kind of have a second check on some of the data that comes out of that economy as well. Now, if you look to the other side of the page, you'll see, as an example, Italy and South Korea, and two very different experiences, but again, both probably peaking a little further ahead of the curve than we are, and hopefully they're past their worst points as well. So I think at that point, the focus then turns away from the virus and isolation, and the discussion, which I believe we're starting to think about here, is how do you reopen the economy? What's that transition period, and what does that look like, and how long does that take once you get to that peak? So now going back to some of those supply shocks, as I mentioned, the supply shock of factories being shut down, combined with the greatest demand shock we've seen, consumers around the world on lockdown, and then you again overlay that with oil price shock, again, less demand, more supply, as two of the biggest oil producers in the world have decided not to slow the supply up until recently, which has had an effect on economies as well. So we'll start with the supply shock, and you can see there, again, some data out of China, industrial production literally going off that cliff in the second half of this quarter. Within this quarter, you'll see that there. What I'm pleased to report is, even though it's detracted by over 15% from the high in late 2019, the most recent reading over the last few weeks it's back to slightly positive. So they are back to work slowly, and we're starting to see some positive signs there. And you can also see that on the next slide over the Purchasing Manager Index for Chinese manufacturing. And the survey suggests, again, a steep drop, but you see a steep incline as well. And again, the resurgence of some activity in that economy. So if we can model in other parts of the world this type of reopening or transition to the economy, that would be certainly a positive sign for North America and Europe. That being said, the Chinese government was able to take certain draconian measures that we will not and have not been able to do, just based on the relationship between the populations and the government, and the differences between those countries or China and much of the rest of the world. So it's expected that our transitionary period will certainly be a little bit longer than we've seen in China so far. You look at the demand shock, and the best way of and the harshest way of looking at that visual are jobless claims in the U.S. And up until this data. You'll see it going up over the $6 million mark as people come home. At the time of this, it's just over the $20 million people mark. And again, those are people that are applying for jobless claims in the U.S. And you'll see at the same time, consumer confidence has also taken a steep decline based on unemployment, based on lockdowns, affecting the consumer, not willing to go out and not able to go out and, of course, consume, which is really the backbone of the U.S. economy.
So what you're saying on that one chart there, the initial U.S. jobless claims, that right-hand line is not the edge of the box of the chart. It's the actual line of the graph.
That's right. Yes, that's right. Yeah. So that's essentially the spike. So that's the increase, and you can see how far back this goes. You can see the little bit of a spike there around that 2008, 2009 marker, which signifies the global financial crisis, and then you see where we are today. So again, when we talk about this demand and the supply shock, something we really haven't experienced in modern history, and how significant it's been up until this point.
Yeah, interesting.
Yeah. And then, the oil shock, and if you've opened a paper, if you've driven by your local gas station, you may have seen the price of oil come down significantly, and you'll see that depicted there. And, certainly moving below that 2016 low. And, in a simple way, again, it's a relationship between supply and demand. When you don't have as many people on the roads, when I'm looking at, traffic cameras here in Ontario, the 401, and it's quiet at 6 p.m. during rush hour, you get an idea of how many people are actually not on the road and consuming and demanding that gasoline, that oil. When you incorporate that with Saudi Arabia and Russia not decreasing the amount of supply into the market, rather increasing it over a period of time, you get an environment where you have an abundance of oil, a much more supply than you need with little demand, which essentially pulls that price down significantly, which is what we have experienced in the short term. However, a lot of due diligence that goes into expectations around oil and the companies that are based in the energy sector look out over a longer period of time, and you can see forward contract prices recently, April 2020, going out. It is upward sloping. We do expect the oil price to increase from here. And over the next year, those future prices are pricing in oil between that low 30 marker, increasing to closer to about 40. But you can see over a period of time, for many years, oil is expected to be at a lower price than we've seen historically. So now to talk about, a little bit of monetary policy and then to look at some of the overall stimulus that's gone into the market. The numbers there you see are key central banks across the globe, and you'll look at what their rates were on February 28th, 2020, and then you'll see what they had lowered them to close out the quarter on March 31st. So the Federal Reserve dropping their rates by 1.5% in less than a month. Bank of Canada to the same degree, 1.5%. The Bank of England, European Central Bank left their rates. They decided not to go negative. And of course, the Bank of Japan has been experimenting with negative rates for some time now. But you can see how significant it was, especially in Bank of Canada, which did not decrease rates at all in 2019, while the U.S. Federal Reserve was decreasing rates, and how significant that decline has been. So you look at the other side, and what you were talking about, Scott, bond purchases over a period of time. And it's harder to read if you were to look at the colored lines there, but the Federal Reserve, the European Central Bank, Bank of Japan, and that purple line representing the total and what it's expected to do for a period of time going forward. And again, these bond purchasing programs surpassing the levels that we experienced during the financial crisis. And especially happening in a much quicker time. Policy changes over the last few weeks have been more significant and have happened much faster than what we experienced in 07, 08.
But is that not because the interest rates were higher in '07, '08, so they actually had that lever to pull as well?
Yeah, that's true. That's a good point. Rates were higher. So the rate increases that we saw, we've talked about this being, the bullets in the gun, so to speak. They drew out all the bullets they had. They felt they would be more significant if they would put them to work in getting in front of this as best as they could, which I think is what they tried to do. And instead of dropping a rate, for example, by 0.25% and waiting for the next meeting, really dropping rates by 50 basis points at a time, ad hoc, in between their meetings to really signify that they were behind it. And in terms of their toolbox, what they've said, in terms of their bond purchasing or making sure that there's stability into the financial market, which there is, there's really no end to the power, or at least the commitment they've made. So you're right. They had a little bit wider to go, but I think them knowing they didn't have the same type of tools, meaning rates weren't as high through this experience, they wanted to get it in quicker and not wait too long and not procrastinate so you don't have that snowball effect. So if we were to look at not only what we've done on the monetary side, but you look at fiscal stimulus that many governments have put to work, you can see how significant they've been. And I'll focus on the very end where it says, liquidity injection and fiscal stimulus in a few of the largest areas in the world, including Canada there at the bottom. But you look at the U.S., they've injected $4.8 trillion of liquidity into their market. The fiscal stimulus, again, fiscal representing the paychecks that the government is sending to people that are unemployed given COVID-19 at $2.7 trillion. A total of $7.5 trillion has gone into the U.S. economy, again, to help it offset the weakness on this pandemic. And that represents 35% of the U.S. GDP, which is significant. To the bottom of this table too, Scott, you'll notice Canada, the numbers are significantly less, but still represent, based on the size of our economy, 33% of GDP, right? So, that 0.4 represents $400 billion of liquidity injected into the market, $180 billion of fiscal stimulus as well. So 33% of our GDP on an annualized basis has been pumped into our economy here in Canada. And when you look at that on the world, you'll see global GDP, 17% of global GDP has been pumped into the economy, which is significant and certainly signifies the weakness, that supply and demand shock that we're all experiencing and we've witnessed in the economy.
And that happened.
And in the case of the U.S., that's more than double than what they've done in the past in history. So that's this is extremely significant. We can't understate that.
Well, no, and it's that not only the size. I mean, the magnitude is phenomenal, but the pace at which it happened.
Yeah.
And when you throw money at a situation, you got to remember that's what got us out of the 2008 global financial crisis, right? The U.S. had to throw tons of money at it, and this is more than double that. And it's like a rubber band or a slingshot that's pulled back too far. Eventually, this kicks in and has a positive impact. We just need things to feel less bad in the market.
Yeah, right.
Yeah. And the focus on where that money is going has also been a little bit different than what we saw 11 years ago. That too big to fail moniker hasn't really peered its head, where the focus now has been more on small businesses, individuals, those that employ the greatest amounts of people, and trying to get cash into their hands to make sure that their businesses can stay afloat, of course, and they're able to support their workers as best and for as long as they can until we can get past this. But Mike's right. The amounts on this page are significant, and a few exclamation points for this slide. So, in terms of the environment we see we're playing out, the path forward certainly depends on the control of the crisis and the pandemic, of course. And we feel the longer this goes, the greater probability that certain businesses may find themselves, not existing in the future, or more people being added to those jobless claims numbers. So much today is dependent on how quickly we can get the spread of this virus behind us and move on to that transition period. So maybe, Mike, I'll pass it over to you, talk about our positioning. I probably took a little too much time there, but this is how we're positioned.
I'll try to keep my closing comments fairly brief, and we'll cover a few of these slides quickly. But tactical positioning, we talked a little bit about. We were defensive going in. We were underweight stocks. We were overweight global equities, which have done better than Canadian equities. We've been very defensive around the kind of stocks we've been holding, and on the bond side, we've kind of moved down to our biggest underweight in high yield bonds that we've ever had. And so that, obviously high yield bonds have been hit a little bit harder than more conservative core bonds. So, we think we did a pretty good job just going into this. We've capitalized a few times on rebalancing back to a more neutral weighting to equities over the last few months when markets were having some of the most devastating downturns. And so we're now very well positioned for what we think will be an inevitable recovery. We don't think we're necessarily at the bottom, but maybe we look back and say March 23rd was it. We might see some more volatility. We're kind of expecting that over the next few months, but we do think we're in a bottoming cycle, and there's going to be a lot of opportunities for us to lean into some of the areas where we see some more opportunity. Maybe we flip ahead a few slides to alternative investments. These have really been, a golden part of the portfolio during this, really holding up very well. Real estate, obviously we might face some challenges there with tenants looking to renegotiating terms, or at least on a short-term basis. But we have a very high-quality portfolio going in, very diversified right across the country, over 200 properties, high-quality tenants. On the retail side, tenants like Loblaw, Shoppers, LCBO, tenants like that are not being hurt through this. In fact, we're seeing some pretty significant lineups out those doors, right? Infrastructure, we got government contracts, power authorities that have committed to pay us over 20 to 40 years for the power we're generating or the traditional infrastructure we built. So, that's probably one of the most stable parts of our portfolio during this. And even private loans, we've got commitments with good, solid security against the assets of these operations that are worth hundreds of millions of dollars. So, while there could be some strain on some of the underlying businesses, we think we're very high up the pecking order there and feeling quite good about all three of these asset classes, really. I think this one is really paints the opportunity in a very positive picture. We have not seen a relative opportunity between stocks and bonds look this attractive for 65 years in the markets. What this chart is showing is what percentage of stocks are actually paying a higher dividend than 10-year bond yields, and it's almost 80% today.
Yeah, and, wow.
I mean, this goes back to 1990. So, I'm not saying that today is the day that everybody needs to invest in stocks, but we are in a bottoming cycle, and we haven't seen this kind of relative opportunity in a long time. So our advice is to stick with the long-term plan that's been put into place. Now's not the time to get more defensive, move to cash. Now's the time to stick with it. And if anything, lean into this opportunity where you can, with spending a little bit less, first of all, and maybe adding a little bit to the portfolio. This one shows the worst months in market history. In recent market history anyway, going back to 1945. And you can see that all the negatives in those months are significant, 10%, 21% in 1998, down 17 in October 2008, down 12% in March just now. And on average, it's down 13%. But the 1 month that follows that, on average, is up 3.4. And we're seeing a really nice recovery in April. So when we produce this, we're not surprised that we're seeing a bit of a recovery here, because after the worst of the times, sometimes you get the best of the times. But more telling, 12 months out, up 18%. It just shows you that, times like March 23rd, where the market, it feels like it can't get any worse. That's usually the time to, take a counter view and lean in. And, this is just historical numbers, so we'll see how it plays out this time. We got over 600 people that we've moved off site, working from home, and it's business as usual. In fact, I kind of joke that everybody's getting probably an extra 2 to 3 hours out of everybody every day, because there's no commute into Toronto or Vancouver or the respective cities that we work in. And our systems have held up. Our web systems, our reporting, we got all the reports out in record time this quarter, even though it wasn't the best of news. But it's business as usual here. You got 600 plus people in behind the scenes, in behind Scott, Ryan, myself, working every day to pick the best stocks and bonds within the portfolios and positioning things for the opportunity that we see ahead of us. So hopefully that instills a little bit of confidence that things have gone pretty well on a relative basis through this. We're coming out on the other side very well with a nice recovery now in April, or since March 23rd, and if anybody wants to talk in greater detail, we're more than happy to do so.
Well, that's fantastic, guys. I mean, I really, the simplicity, I mean, there's a lot of technical information that we just covered there, but just to be able to speak to some of those charts and graphs in a very, plain English type way, I think really helps get the message across that, really at this, we know what's happened. We know what needs to happen in order for things to get less bad, what's being done in order to position the portfolio to take advantage of that so that we can, when we come out the other side, everybody's going to look back and go, oh yeah, I remember that. That was, I'm glad we did all those adjustments because we're sitting here in a great financial position as a result. So I just want to say thank you for all of that. And, being able to transition your whole team as quickly as you did to get back up and working business as usual. I mean, from our perspective, working with you, there was we didn't notice any issues whatsoever. So it's just nice to see that when we've got companies that are sort of progressive and ahead of the curve that way and can adapt quickly, that makes a huge difference. So thank you very much for your time today. And as always, we'll look forward to an update, hopefully a more positive update the next time we go around.